Gold stay at Hotel California. When Don Henley and Glenn Fry wrote those famous lyrics, little did gold investors think it would be their problem. Like a guest at the infamous Hotel California, gold investors find themselves trapped between a rock and a hard place. Despite being able to check in with ease, escaping this hotel might be trickier than most investors anticipate. In this volatile landscape, gold funds wane and lawyers prioritize protection over profitability. Investors, once optimistic, now exhibit caution and are often frozen, and the flow of funds seem more ebb than flood. But what lies beneath this shift? The liquidity and the volume problem. In short, gold and nearly the entire resource sector is suffering a problem with liquidity. And more importantly, there are no large new gold funds being created. In fact, the large gold funds that are investors in these equities are seeing net outflows. This means that the funds are selling to meet redemptions by their unit holders, and any deal the fund wants to buy means they are selling what they already own. Capital rotation. Put simply, the generalists are not buying the gold stocks. Below is a chart which shows the net creation and redemption of ETF units, also known as the fund flow for major gold ETFs. The trend is your friend right now. Look at that red line. That's going back to 2016. As you can see, fund flow into the sector peaked in the mid-2016, and since then, more money has come out of the sector than gone into it. With the lack of fund flow in mind, let's examine the performance of the mining sector across the different segments. Perhaps the most telling bearish signal is the sheer number of companies that are trading below their 200-day moving average across the majority of the industry segments, meaning the majors, the mid-tiers, the junior producers, the developers who are building their mine but not yet producing, and then the explorers. Equity financing, a lens into the appetite for gold stocks. One of the best ways to gauge market sentiment and investor optimism is through financing activity. Companies across all sectors are continuously trying to grow, build, and acquire new assets and talent. The mining sector is no different, especially when considerable growth comes through mergers rather than internal organic growth from operating sites. This means the companies need to raise cash in order to trudge on. The chart you're looking at right now shows the total equity financings completed by companies in the gold sector over the years since 2008. Total deals completed this year are roughly half of the previous 2 years and significantly down since the onset of QE post-global financial crisis in 2008. Yet, exploration and CapEx programs have gotten more expensive, as have lawyer and accounting fees, which means even few dollars are going to value creation. You're getting less for more money. Gold equities. You can check in, but can you check out? I have written before the secret killer of the mining sector, which is illiquidity. Misunderstood by most investors, the lack of liquidity can destroy returns. How so, you ask? A stock is illiquid when there is minimal trading activity relative to the company's size and number of free trading shares. If a stock is illiquid, it makes it difficult to sell shares once purchased, simply because there are few buyers. This situation magnifies when there is negative news and all existing shareholders run for the exits and crater the stock. The next chart shows the dollar volume traded for a group of large gold-focused companies that are listed on major exchanges in Canada and/or the United States. The dollar volume is calculated as the total number of shares traded multiplied by the average share price of the day. In recent years, you can see that it's been sliding lower, indicating less activity and less investors bringing hard dollars into the sector. The steady decline is noticeable even in these large cap stocks that generate billions in revenue and have research coverage by many institutions and are held by the ETFs. Remember, it's all about capital inflow. Before you invest, staple this to your desk. Our head office in Vancouver sees countless resource deals every week from companies looking for financings, to companies looking to go public and everything in between. One of the first questions we ask ourselves is, will this company have a liquid market post-financing? You might have an excellent project economics. You might have a brilliant and illustrious management team. But if you don't have the ability for the market to look at your stock, do you even exist? As an investor, you must be mindful of a shareholder turnover and liquidity in the company you plan on buying or own, or else you'll find yourself in the situation where you can check in at any time you like. But can you leave? Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.